The question here is mutual funds right for you? Is it the right kind of investment for you? So I want to highlight the pros and the cons of investing in mutual funds. Let me first of all highlight the advantages. When it comes to the advantages, we want to take into consideration uh, the issue or the concept of diversification. Mutual funds actually they pull money from many investors to invest in a wide range of securities, which might include stocks as well as some bonds and other asset classes. This diversification tends to reduce risk by spreading investments across different asset classes, across different sectors, across some different industries, which help to protect you from uh, portfolio volatility, in the overall portfolio. We have professional management, which is a key advantage here. Mutual funds are managed by professional portfolio managers who research and select securities based on the fund's objectives, based on the goal of the mutual fund. This is beneficial for investors who lack the time, or the expertise to manage their investment themselves. We equally need to consider liquidity is a crucial advantage of investment in mutual funds. Mutual fund shares can be bought or sold at the end of each trading day. Usually, you buy at the net asset value price. It offers flexibility, and not only that, there's that ease of access to your investments. You can very easily buy, and you can also sell seamlessly. So it offers liquidity. The next item there is low minimum investments. The initial capital outlay is quite minimal. So many mutual funds have low initial investment requirements, making them accessible to individual investors, even with even for those with limited limited capital. And then we need to look at convenience. A mutual fund provides a simple way to invest without needing to actively monitor your portfolio, compared to buying individual stocks or bonds. So fund managers handle the research, they handle the buying, and as well as they take care of the selling, of securities. You don't do it yourself. The manager is there to handle everything on your behalf. So moreover, there's that variety of fund options. There is a broad range of mutual funds to suit different individual investment goals. There is equity fund, there is bond fund, there's balance fund, there's index funds, and there's sector specific funds. And then lastly, you have automatic investments and dividend reinvestments. It's a key advantage of mutual funds. Automatic investment as well as a dividend reinvestment through what is called a dividend reinvestment plan. So many mutual funds allow you to set up automatic investments, making it easier to contribute regularly. Additionally, dividends earned in the fund can be automatically reinvested to purchase more shares, compounding returns over time. So these are This strategy is called dividend reinvestment plan, of which I've spoken about extensively in other videos in this channel. Let's look at the disadvantages, the pitfalls, or the drawbacks of mutual fund investments, of investing in mutual funds. Number one is management fees and expenses is something worth considering. Management fees as well as expenses. So mutual funds charge fees to cover management and administrative costs. And so actively managed funds tend to have a higher fee due to research and trading involved. And these fees can eat into your returns over time, especially if the fund doesn't outperform the market. That is the core problem here. After fee, you discover that most of these mutual funds hardly outperform the markets when you deduct fees and expenses. There is that risk of underperformance. Actively managed funds aim to outperform the markets, but there is no guarantee of success. Poor investment decisions by the fund managers can lead to underperformance, potentially resulting in a lower return than what was initially expected. You discover that a large majority, of active managers hardly beat the markets, and those that do, the few that don't do it consistently. That's the pitfalls of actively managed mutual funds. That's why passive index funds is gaining ground, gaining acceptability and popularity nowadays. Funds are flowing out of actively managed into passively managed mutual funds. There's that lack of control. An investor in a mutual fund, as an investor, you have no control or a say in the individual securities the fund invests in. You can't really have a say because the fund manager is there to do everything for you. And so the fund manager makes all decisions on your behalf, which may not always align with your preference. It may not really meet up with your preferences, but that's what you ought to take into consideration before you invest in a mutual fund in the first place. There is also the potential for higher capital gain distribution. Potential for higher capital gain distribution. So mutual funds often distribute capital gains to shareholders if the fund has sold securities for a profit. This distribution can result in an unexpected tax liabilities, especially if you hold the fund in a taxable account. Don't forget the fact that whenever there's a redemption, there's always tax implication. So when the fund sells shares, sell its holdings, you discover that the tax implication is quite is somewhat considerable, it's remarkable. There's fees for sales and redemption. So mutual funds charge sales load. It's a fee when buying or selling shares. When you buy, they will charge a commission. When you sell, they will equally charge a commission, known as a sales load. And there's also what is called redemption fees. If shares are sold, you charge what is called redemption fees before a certain period. If maybe you are expected to hold the mutual funds share for a year and you sell before a year, then they will charge you a kind of redemption fees. It's an important attribute that we can't afford to ignore. So these additional costs can reduce your overall returns. There's also the disadvantage of over diversification. While diversification can reduce risk, we all know about that. Mutual funds sometimes become overly diversified, managing, as many as sometimes hundreds of stocks. or securities in the portfolio. So they are over diversified. Over diversification can dilute the potential for higher returns if the fund holds too many securities with low growth potentials. If the constituent holdings offer low growth potentials, it will hurt the fund negative. It will really actually hurt the fund. It will affect it negatively. Okay. So this market risk we can afford to disregard. Like all investment, mutual funds are subject to market risks. The risk inherent in the overall market. So equity funds in particular can experience significant volatility during market downturns, potentially leading to losses for investors. It's very common among equity funds because the market tends to gyrate a lot, it fluctuates a lot. There's that inherent volatility in the market. As in a market downturn, you discover that it will affect investors' returns. And so, in conclusion, mutual funds offer several advantages such as professional management, diversification, and ease of use, making them a good option for many investors, particularly those that cannot manage their portfolio themselves, that cannot really pick, that lack the skills, the expertise, and the experience to pick individual stocks. So a better alternative is investment in mutual funds. But if you are conversant with the videos here, you watch them regularly, you should be able to learn how to manage your investment. That's the aim of this particular channel, to be able to learn how to manage your investments at the end of the day.